Hello, welcome to Any Answers Answered for May 2018. Tim and I have had a look through the various questions on the Any Answers page and come up with a couple to have a look at. The first today relates to rent-a-room relief. It is a question from, I'm not sure, PAL-AC or PAL-AC. A husband and wife live together in their main residence. The property is owned fully by the husband and the client rents out a spare room in the property. Would the rent-a-room relief only be allocated to the husband as the property is in his name, or could it be allocated 50-50 as they live together and pay the bills jointly, etc., etc.? Tim, a fairly straightforward question, but is it a straightforward answer?
Well, I think it is a straightforward answer. There are only 3 postings to this, so let me just run through those. John R says, unless the renting out can be classified as a business partnership, the rents have to be allocated 100% to the husband as the property is owned solely by him. Now, I would agree if we were looking at a normal rental business. And the difference here is that rent-a-room relief, what I describe in the lecture room as the Roger the Lodger relief, is available where you're letting a room in your own home and the person living there is living there almost as part of the family. And it's very different from a landlord renting out a property, giving exclusive occupation to the tenant. If that were the case, then yes, it is clearly the individual with the beneficial interest entitlement to the property and the income that would be taxed on it. But with rent-a-room relief, it's a little bit different, and I'll say more on that in a moment. Wanderer then replies sort of on those lines to John R, saying you don't have to own a property to get rent-a-room relief, and that's very true. Of course, somebody who lives in rented accommodation might nevertheless rent out a spare bedroom.
Sub-bedroom.
And rent-a-room relief would apply. And then our old friend Portion in 11 says you do need to have rent-a-room receipts though, which would first necessitate having an entitlement to some of the income. And behind that is the point that a husband, for example, cannot simply put his income on his wife's tax return instead. So what we have to do is go back to fundamentals and say, well, look, you've got Roger the Lodger living in the house. Rent-a-room relief clearly applies in this scenario, but how do we deal with the income? If it's paid, let's say, into a joint account of husband and wife, then there's a very strong argument for deciding basically where to put it on their tax returns. And you might be able to argue that the tenant is there, perhaps against the better judgment of the husband, who wants nothing to do with Roger the Lodger, and instead it's the wife who's providing the cleaning, the cooking, the whatever, the other parts of what the guest tenant enjoys, and so the income should all be put on her tax return, even though she has no equity in the house. Or it could be 50-50, or it could all be the husband's. So I wouldn't beat myself up too much about where the income goes, just because the ownership is in the sole name of the husband.
One thing I'd just very briefly want to touch on there, the idea going back to John R's point, which is that if he owns all of it, then you can't share the rental out. A very common mistake that people still keep pushing on here. People say to me, oh yeah, but that's when you do Form 17 and then you can do it. It's rubbish. Even with Form 17, there has to reflect
the actual beneficial ownership.
Exactly.
Correct.
Right. Our second question this month relates to a company car question. This one comes from a very simple name, Slim. Slim asks, how to make a company car unavailable. Client can't drive for 6 months. Other than cancelling the lease, how else can it be made unavailable in the eyes of HMRC? Presumably we're looking to make the car unavailable so that we don't have to pay the benefit in kind on it.
Yes, I mean, the basic point is that the benefit in kind, which can be a significant tax charge on the employee, is not applicable unless a car is made available to an employee by reason of their employment. And for any period during which the car is not available, then the benefit in kind does not apply. Now, there are, unlike the previous question, 25 answers posted to this question, so it's generated quite a lot of interest. In the title to the question, it indicates that this is an OMB working from home. So it's an owner-manager who's presumably incorporated. They have their own company, the company's bought the car or leased it and is providing it to them at their own home. Well, if you're a one-man or one-woman band OMB working from home and your company's provided you with a car, a bit difficult to make it unavailable. But the taxpayer presumably has been banned for 6 months. It may be medical reasons, we don't know. So what can you do? And the suggestion that you sawn it, complete the statutory off-road notice, I'm afraid isn't going to cut it. Various answers suggest if you're banned, get a sawn, store it in a friendly garage, confirm that they've done so. Others say if it's not MOT'd and uninsured, you need to do that as well as sawn it, and so it goes on. But actually, again, it's Portion 11 comes up with the very simple answer. Have you not read their manual? And gives the link to the Revenue's Employment Income Manual, which does make it very clear. It says, although this is the revenue interpretation of the legislation, which simply says available or unavailable, it says the car does not count as being unavailable to the employee simply because the employee is banned from driving or out of the country on business or holiday, or unable to drive the car for some other reason, for example, illness. And the distinction I've always made in the lecture room is between the car being unavailable and the employee being unavailable to drive the car. The car can still be available to the employee, but the employee not unavailable. And the revenue guidance goes on to say, in some of these circumstances, it may be the case that the employee is unavailable to drive the car, but that's not the same as the car being unavailable to the employee, which is what the legislation requires. So unless there's some other evidence, see below, the benefit continues to apply. Neither does the car count as unavailable simply because there is no current road tax, MOT certificate or car insurance. So they deal with that point about the sawn, etc. And so the answer, I think, to the original poster of this question is that they're going to find it very, very difficult indeed to avoid that benefit in kind charge unless they dispose of the car, send it back to the leasing company if it's leased, or perhaps provide it to somebody else in such a way that it's unavailable to that director shareholder.
Or simply make sure that it's clear that it has been made unavailable by some sort of contractual change. That has, I've seen in a number of situations, been used to take it away. And it's the point you're making. It's not because the person can't drive it, it's because the company has said, you touch that car.
Yeah, I mean, the difficulty with this, and in fact there was another posting on this answer that referred to removing the spark plugs. But
that doesn't solve the problem.
Ain't gonna work. The difficulty, I think, for the owner-manager is that the tribunal, if it went to tribunal, might well agree with the revenue that a contract between the company and the individual director saying that for this 6-month period you may not drive this car is unlikely. It's not been tested, but it's unlikely to persuade a tribunal that that really has made the car unavailable. If it's still sitting on that director's drive, then I think the tribunal would disregard that sort of board minute or contractual statement. Of course, where we're looking at a larger company with other employees, then that is indeed a means whereby you can prohibit the employee from using that car. But even then, you know, if the employee has the keys and access to the car, it's not actually
it's very difficult.
Unavailable.
But the phrase you use, which I thought was very useful there, is that it's not that the if it's that the car is unavailable, that's one thing, but what we normally see is it's the individual who is unavailable to drive
and that's what's happened here.
That doesn't create a resolution to the problem.
Yeah.
Well, hopefully useful. Do join us again next month when we will pick another couple of questions from the Any Answers pages. But for this month, goodbye.